Everyone wonders what really drives mortgage rates, and it's not what you think. Paul knows real estate, and he also knows mortgage rates. Here's the clearest breakdown you'll find.
I just want to ever so briefly run through why I spend all of this time on the economy. It is because this is what sets the stage and establishes where mortgage rates are going to be at. It's not the federal funds rate. That's interconnected and related, but our mortgage rates arrived at. And this is overly simplified, but with enough detail to be helpful. You have the economy. The economy impacts the bond market. What is the economy? It's employment, it's inflation, retail sales, manufacturing output, industrial production. All of those things go into the economy and the GDP, and now we have, kind of more important than ever, tariffs and trade policy affecting that. Then we also have Federal Reserve policy, which is both affected by the economy and affects the economy. And the primary levers they have to affect the economy are the federal funds rate, which is essentially the rate that banks borrow from each other overnight in order to meet minimum deposit requirements. And then they have quantitative tightening and quantitative easing. You can also hear this referred to as QT and QE. Essentially what that means is they either put money into the economy or pull money out. We had a lot of QE going on during the pandemic when they were buying billions and billions and billions and billions and billions of dollars of treasuries and mortgage-backed securities every single month, like massive portfolio of these assets. And that is why mortgage rates got so low during the pandemic, because you had the biggest dog on the block, which is the Federal Reserve, buying up just massive swaths of these securities, which meant that you could offer lower yields in order to sell those securities. So all of these things affect the bond market. Why does the bond market matter? Because mortgage-backed securities are part of the bond market. In short, a bond is a debt-backed instrument. It is something where, barring the insolvency of whatever's backing that up, you are going to get a guaranteed rate of return and your principal back. And so mortgage-backed securities are part of the bond market. When we talk about conforming mortgages, why does that matter? Because they are resold, and they are resold packaged into these MBS products and then sold in the bond market, where they have to compete with other bonds, US treasuries, and the like, and so they have to be competitive. The lower rate that can be offered for mortgage-backed securities and have those products sold, the lower mortgage rates can be given to the consumer. So in short, kind of a quick breakdown, that's why I cover the economy. That's why all this stuff is super important.